Here at C-SPAN on this morning's Washington Journal, Simon Johnson, professor of economics at MIT and a senior fellow at the Peterson Institute on International Economics. Thanks for joining us this morning.
My pleasure.
One of the sub-headlines this morning in the New York Times, and major headline, of course, is about the drop here in the U.S. and markets worldwide, but one struck my attention was global fears of a recession growing stronger. And a lot of articles have written about that other markets across the world are seeing that the U.S. proposed rescue, bailout of the financial markets may not be enough. Is that what's driving these fears overseas?
That's, broadly speaking, exactly what's going on, Bill. I think people have looked at the Paulson plan, the rescue package. They think it's okay, they think it's helpful, but they think it's a pretty small pebble thrown in a stormy ocean. I think that's the line in the New York Times this morning. And they feel that the global recession is coming. And that forces everyone to sort of reevaluate the value of their stocks everywhere in the world. And of course, overlaid with that, we have continuing worries about credit markets. So it's one thing to have a global recession as everything slows down. That by itself is not good, but not terrible. The problem is how that interacts with credit markets. Do credit markets become more disrupted? And there's a lot of worry in Europe in particular today.
Now, the U.S. has taken steps not only in the financial markets, but to prop up banks here in the U.S. Other European countries in particular are not, the EU's not taking a consolidated effort towards this. They're doing it country by country. How did this happen?
Well, it turns out that, as some people had been warning for some time, the Europeans were not ready for something like this. So they have a fairly decentralized system for dealing with banks. And they hadn't really, I think, turns out, thought through what would happen if a bank, a big bank that's based in one country with branches in lots of other places, got into trouble. Who's doing the rescue package? In the United States, we obviously know it's the Fed, it's the Treasury, they're dealing with the whole country. The European Union doesn't have much of a budget itself for this sort of thing. So it's up to individual countries, but there's a lot of argument about the principles, about who should actually pay. You know, why should the taxpayers in Germany pay for problems in France, for example, and vice versa? These are all good questions. Unfortunately, they haven't thought about them until this weekend.
But the taxpayers in the U.S., as part of this $700 billion, will pay for investment banks, anyways, based overseas.
That's a good point, which I think we've actually lost track of in the last few days in the debate here. I think you're right. I think we have to see the details and how that actually work, but I think you're right that we will be paying to help out some foreign investment banks. And that was actually one reason Mr. Paulson, at the very beginning, I think quite sensibly asked the rest of the G7 to come in and have an organized rescue plan. I think they regret now having turned him down on that one. They have another chance on Friday when they're all coming to his house, the U.S. Treasury, to have another go-round. I think that'll be an interesting conversation. But you're right, though, that there's going to be, however you do it, because these banks are so global, and because the everyone's investment portfolio is global, it's very hard for your taxpayers just to bail out your people.
What about the International Monetary Fund, the World Bank? Would they play a role in this?
They certainly could. There's you know, a lot of things to be done here. I think the World Bank will play a very important role helping some of the poorer countries in the world get through this. It's going to be very tough. Mr. Zellick, the president of the World Bank, was quite eloquent about this yesterday. I think they're getting ready for the storm. The role of the IMF is an interesting one. Certainly they will have a role anytime a country needs to borrow, and there will be countries that have to borrow. And then they're also the sort of main repository of advice on how to deal with crises. Some countries like to ask them openly, some countries like to ask more discreetly. It's always a little uncomfortable if people know the IMF is helping you out, but they'll be there.
And those organizations also have a great deal of work that they do in developing nations. So this is a little bit off the track. With all of this, the financial turmoil that's going in markets in Europe and in Asia, how does this affect sort of budgets that the IMF, the World Bank, in terms of their development, how much their ability to loan to those countries?
Well, the bank and the IMF's lending is somewhat locked in. It's a good question whether they have enough. I think both of them may actually need to go raise more capital before this thing is through. But this is a huge global problem we're facing, Bill. Everybody's going to be affected. Commodity producers, for example, they were very badly hit yesterday. Brazil was down sharply. Russia was hit by that and some other problems. But you've got about 90 countries in the world, 90, maybe a little bit more, who primarily depend on commodity exports. Those commodity prices, I think, are going to come down, and that's what the market's saying as well. If you have a global recession, that's going to lead to budgetary problems for everyone. Even if you've run your country carefully, you almost certainly haven't planned on commodity prices dropping dramatically and being shut out from international capital markets.
Let's get our callers involved in the conversation. 202-737-0002 for Republicans, 202-737-0001 for Republicans, 02 for Democrats, 0205 for Independents and all others. Headline of the Boston Globe this morning, worldwide worry, and this is reflected in headlines across the not only across the U.S. but around the world. Let's go to our first caller, Waynesboro, Pennsylvania, on our Republican line. Hi.
Yes.
Waynesboro, good morning.
Good morning. I'm looking at what's going on television and watching as they go after the stock people who are selling on the stock market and whatnot. But I really believe that what is going on in the markets has to do with legislation that's been enacted over the years that has deregulated that industry. And in particular, I'm interested in wanting to know what role the enacting of the Community Reinvestment Act had in the creation of the subprime lending industry. I've been looking into that, and I see that really is at the bottom of what has happened. And is it true that banks who do not comply with this anti-discrimination lending law could be fined penalties? Is this the bottom of how this really got started?
Thanks, Pennsylvania.
Well, I think it's a very good question. I would separate actually deregulation from the Community Reinvestment Act. I think deregulation is a separate issue, and that has certainly played a role. It changed the way the banks run their businesses, and it led them to pursue some of the problem loans that they're now trying to deal with. The Community Reinvestment Act was part of a broader set of initiatives where there was a big effort, probably starting 15 or so years ago, to try and expand homeowning in the United States. Homeowning obviously has some big advantages, and there was a view that if you could get more people into homes, this would help on lots of dimensions. Of course, what it led to more recently, this is quite recent though, the big subprime problem was just in the last couple of years. 2005, 2006, and actually 2007 is when it really got out of control, when people had incentive, if you like, to push loans on people who really weren't qualified, who wouldn't be able to pay back the loans. And it was a little bit of a scheme that was based on the assumption that house prices would continue to rise, and that was unsustainable. So that was a problem. But what I emphasize, there's lots of elements to the problem here, and lots of responsibility to be shared.
And the UK had its own subprime issues, didn't it?
Well, the UK, Bill, has a big problem with housing and housing prices. They've had a big run-up in housing prices, and now we have people saying, people who are known to be optimistic about the UK market, saying house prices are going to come down 25%. It's not, strictly speaking, subprime. So subprime means people who didn't have good credit records.
Right.
So the problem in the UK was not subprime. The problem was that they would give you a 100% mortgage. All right, so you get negative equity very quickly, and of course it's all based on all credit ratings are based on the assumption of they know what your income is going to be down the road. If you hit a big recession, which we're about to hit, then everybody or a lot of people become subprime.
The Treasury chief over there is Alistair Darling, and this morning's Wall Street Journal covered a little bit of his meeting yesterday evening. He met yesterday evening with chief executives of several top banks in order to hammer out a plan for shoring up their capital, said a person familiar with the matter. The meeting didn't produce a clear outcome, according to another person. How much pressure is he under, the Treasury chief in the UK, to get a deal done similar to what was done here, similar to the several deals done here in the US?
Right. So the Chancellor of the Exchequer, Mr. Darling in the UK, is under a lot of pressure to try and deal with this. The banks look shaky. And of course you have the situation in Europe where, because the governments are making these moves in isolation, not really talking to each other, the Germans are also discussing a big package to save their banks. So if the Germans put a package in to strengthen their banks, and the British don't put a package in to strengthen their banks, then people are going to move money, maybe, from Britain to Germany, and that's not going to be helpful. So they're in a very difficult situation now. There's a global pressure, there's a pressure within Europe, the sort of leapfrogging that's going on in terms of deposit insurance and also trying to shore up the capital of those banks. And I'm afraid house prices are still going to adjust further in the UK. So in a sense, they're earlier in the process than we are. Let's
take a look at, he spoke yesterday on the House floor. We covered it here on C-SPAN. I want to get your reaction to some of the things he said before the comments yesterday. Here it is.
Speaker, these are exceptional times, and I'm in no doubt as to the size of the task facing us and governments across the world in bringing order to the financial system. The process of change will necessarily take some time to work through, and because we're dealing with international institutions and international markets, it will require action not only at a national level here, but also concerted international action. Mr. Speaker, it is right that we look at every aspect, liquidity, capital and regulation, with other countries and, of course, with the financial sector itself. But it would be irresponsible to speculate on the specifics of future responses. Indeed, providing a running commentary could add uncertainty in already febrile market conditions. But, Mr. Speaker, I want to make clear that all practical options must remain open to us, and I've made it very clear that the government is ready with the resources and the commitment to do whatever is necessary, and I will keep the House informed. Our priority at home and abroad is to bring stability to the financial system, to ensure depositors and savers are protected, and to defend the interests of the taxpayer. I commend the statement of the House.
He used the word feeble markets. I hadn't heard that used before.
Feverish, febrile, right? I think that's a good term, actually, for that state. They're clearly, there's some sort of disease that's spreading around the world. People are overexcited. I think there's been way too much loss of confidence. There's been some accidents, there have been some missteps by governments. The situation is not really as bad as people might think, and I think that the headlines in the papers, unfortunately, play up a little bit that issue. So he's trying to calm things down. It's very sensible. But his issue, the key issue is, how does he coordinate with others? I mean, he put his finger on it. The Europeans have to get their act together, right? They can't do it separately, and they're meeting today to work on this. And I think they've got to keep.
Are they further challenging the UK in the fact that they don't use they're not on the euro?
Well, that gives them a little advantage in the sense that when you have a lack of coordination within countries that they're all on the euro, or using the euro, you have a huge problem. So it's actually Ireland last week that introduced a blanket guarantee for all deposits that then caused a lot of destabilization of deposits elsewhere, because people said, oh, let's put our money in the Irish banks. Right? So clearly, it's the same currency. You can't do that. Now, the British have their own currency. They still have the pound, and that gives them a little bit of isolation. But these are very integrated economies, and the UK has a big financial sector, so it's particularly integrated on the financial side. I don't think any of them can really go alone on this.
Let's hear from a Democratic caller next, Richmond, Virginia. Good morning.
Yes, good morning.
Good morning. Richmond, are you there? I think we just lost Richmond. Sun Valley, California, independent. Sun Valley, good morning.
Hello, Bill Scanlon.
Good morning.
It's an honor to speak to you. The first time I've gotten through to you, I really appreciate how you host the Journal. Thanks so much. And Mr. Johnson, thanks for being on today. You know, there's so much talk around the economic woes as of late, and I have to be honest with you, as someone who's definitely not an economist or someone involved in the high financial world, the jargon of this particular subject really just it kills. It really hurts my generalist understanding of the issues. So I was hoping you could help clear up for me. Can you just point to why that the language of the financial world seems to be just so utterly convoluted, and it seems to be there to, in fact, just distract people who haven't studied what particular terms mean over and over again from really grasping what's going on here. When you really break down through all the complicated words, the concepts involved really aren't that complex. Accounting, no offense to all the ledger minders out there, but accounting is not rocket science. Can you shed some light? I really appreciate you guys very much. Thanks again,
Okay,
Bill.
California.
I think that this is a very important point. And I think everybody should be asking exactly a version of this question, which is, explain it to me in plain English. I think it's like when you go to see your doctor. The doctor can tell you what's going on with very complicated words, use a lot of Latin, you won't understand it. And, you know, we should all ask our doctors, put it in plain English. And we can all understand this. And in fact, I have a website, which I think we'll talk about in a moment, where we tried to explain this terminology, because we're getting a lot of questions like this. And I think when you really get down to it, it's very simple. We have a crisis of confidence. People have lost confidence in the financial institutions, and that's a very bad thing, and it has to be addressed directly, and it can be addressed directly. You can turn that around. Once you've got confidence under control, then you have to address the issue of the banks, because the banks don't have enough capital right now. because they took enough losses. Then, at the same time, you have to deal with the underlying mortgage problem. I think that a lot of the discussion, for example, this week has lost track of that. We have a problem with defaulting mortgages and foreclosures in the United States, and forced sales and falling house prices. And you have a death spiral of house prices and foreclosures in some communities. You can see that, and that's plain English. And the other thing which you're going to have to think about, I'm afraid, is if we really do see this severe recession scenario, you're going to have to see some response in terms of a fiscal policy from the United States. So depending on what point that we actually get to turn this around, you may need to see a pretty substantial fiscal stimulus just in order to soften the blow, particularly to soften the blow on some of the poorer people in the society who are going to get hit from many dimensions. I hope that was a jargon-free explanation.
We showed our viewers there a moment ago your website, thebaselinescenario.com, where folks can go and ask questions.
Absolutely.
Post their questions and get them in. Baselinescenario.com. And Mr. Johnson with us for another 45 minutes. If you want to take a look, and if you still don't understand, you can give us a call back.
The most popular section on the site right now is called Financial Crises for Beginners. So you can see why.
There's a story in this morning's Christian Science Monitor I want to get your reaction to. The headline is Why Asian Banks Are Stronger Than U.S. Banks. And just a portion of this, Asia markets are tumbling, but their banks aren't. A decade after their own debt crisis shook the world, Asian banks have so far averted the crippling run of failures afflicting the U.S. and Europe. By staying away from risky U.S. securities, prudent lenders in Asia may even stand to benefit from the current crisis as stricken Western banks seek fresh capital. A handful of banks in Hong Kong and India have had to reassure nervous savers but not pull their deposits. Regulators have also pumped extra money into the credit markets, but there's no panicked rescues of stricken lenders as in Western countries. That's because relatively few banks bought into the promises of U.S. mortgage-backed assets. So,
well, the article is right on the point that they didn't have a direct exposure. But I think it's a little optimistic to say that the Asian banks are not going to be dragged into this. They're obviously going to be affected by the downturn in global trade. They have a big exposure there. And this loss of confidence that we're seeing right now is everywhere. It's everywhere in the world. And we're also starting to have questions. People are starting to have questions. The Chinese insurer announced yesterday that they had losses that 3 days ago the Chinese leadership were denying there were any substantial losses. So the full picture is not really clear yet.
In terms of trade, so as economy weakens here or other European countries, those countries where they may have some financial strength, they're weakened by lack of exports.
Absolutely. The Asian economies, on the whole, are very export-oriented, and they're very competitive. They sell to the United States, and they sell to Europe in large part, and they sell to other developing countries that export commodities. Well, if the U.S. goes down, and Europe goes down, and commodity prices go down, where do you put your exports? That's the problem that Asia is going to have to confront, and the banks will be pulled into it in that way, if not more directly.
Let's hear from Memphis, Tennessee. Good morning, supporter of Democratic caller. Hi.
Hello there. I've been an in-house bank attorney since 1982, and I worked on the Community Reinvestment Act back then, and our bank wanted to acquire another bank, and we got a protest from a community group saying you can't acquire that bank because you're not meeting your Community Reinvestment Act obligations. And our defense to our regulators was, we are making loans in low to moderate income neighborhoods that are consistent with safety and soundness principles, as outlined by the OCC. And the OCC said that's fine. What the CRA was largely enacted to do was to prevent banks and other lenders from redlining neighborhoods, which was to not even make good loans in low to moderate income neighborhoods. And if you could show, these people didn't meet our standard credit underwriting criteria, you didn't get a penalty or anything, because you still had to comply with safety and soundness obligations and standard underwriting criteria. That's one point. Second point, so it is deregulation. When the banks started lending with all these wild, they just let their underwriting criteria go. That's when the problem happened. And to show the types of activities that a lot of these lenders were engaging in, good banks, not only the mortgage companies, but good banks, I recommend the complaint the Illinois Attorney General filed against Countrywide that was just settled by Bank of America, who bought Countrywide for over $8.5 billion. They're going to have to go back and rewrite so many of these loans. And if you read that complaint, you will see just a litany of fraudulent practices. And this is not just subprime loans. This is loans to good credit people. Say, let us get you into this other loan because the banks got more money for those when they sold them. So they were getting people who would qualify for a standard loan into these subprime products because the banks got more money when they sold them.
Memphis, thanks for your call.
I think these are very important points. There's really something for everyone in terms of blame here. Deregulation was part of the issue, and I think the caller laid that out very well. But I have to say that the regulators, with their responsibility for safety and soundness, may not have been paying full attention, or they may not have really been enforcing that, particularly in the last couple of years. And I really do think it was 2005, 2006 when we went seriously off the rails. Unfortunately, that's quite a lot of money because a lot of people refinanced at that time. The caller is absolutely right that, as long as you're enforcing, proper underwriting standards, it's a good thing to reach out into communities and to make sensible loans. And it's when incentives, I think, in this industry, partly because of deregulation and partly because of the way regulations were being enforced or not being enforced, it's when those incentives move towards really pushing loans on people, and arguably, and I guess we're now seeing the legal cases, issues of fraud came up. That's when it obviously became very serious and very tragic for individuals. And it's also become a very big macroeconomic problem for the U.S. as a whole, and because we're so interconnected, for the world.
The Politico this morning has a front-page article on the man who's been tapped by Treasury to start spending the $700 billion. His name is Neel Kashkari. He was a close aide to Treasury Secretary Paulson, yesterday named as the interim head of what's being called the Office of Financial Stability, will oversee the $700 billion effort to purchase the distressed mortgages from the private sector. What do you think the impact will be once they start purchasing the assets?
Well, it should be a positive impact, and I think I and other people have been a little bit surprised that the announcement or the passing of the bill last Friday didn't have more of a positive impact already. It suggests that people are worrying not so much about the mortgage-backed securities, which I think the program will address, but they're worried much more broadly about credit card loans, about auto loans, so it can expand that. They're also worried about the global recession scenario. So is $700 billion a lot of money or a little money? It depends what the problem is. If the problem is just in housing, and just in these sort of subprime loans that are gone, and the Alt A and all these other types of loans that are going bad, then $700 billion, is a sizable war chest, and you can make some substantial progress. If we're facing a much broader issue with credit quality and contraction and recession and synchronized recession around the world, then $700 billion is neither here nor there. And I think that's what people are trying to make up their minds on. And it'd be good if the government, the U.S. government, and also all the governments of the world, they're all going to be in Washington at the end of this week at the G7 meetings, the big meetings of the big industrial countries, and then pretty much all the finance ministers of the world meet on Saturday at the IMF. To sort of twice a year they meet anyway, and this is their opportunity to come out, clearly state what they understand the problem to be, and lay out a roadmap through which we can get out of this. That would really help. So that, in combination with the $700 billion, could reassure a lot of Americans.
Let's go to Mount Angel, Oregon. Good morning, a Republican caller.
Good morning. Thank you for C-SPAN. And I have a question. It seems to me that back in the 90s, before we imported things from China, and before NAFTA and the World Trade Organization and all this, it seemed like we had more sovereignty, America did, and that we weren't involved in the world economy. Politicians didn't refer to the economy as the world economy. It was the U.S. economy. And before Clinton enacted all that, and before we started dealing with the communist country, and now they actually own a lot of our debt, it seems, would our country be way better off financially if that had never happened? And then I have one other point. If I'm from Alaska, and I worked in the oil field, and we've been pumping natural gas back into the ground for years and years. And I know that the Palin administration is going to build the gas line, which when I was working in the oil field was talked about all the time. And the reason they didn't build it was because they were waiting to sell the gas to China, or not China, Japan or North Korea, or not North Korea, South Korea. But anyway, and the reason was is BP, British Petroleum, is running the oil field. And they were waiting and going to build liquefying plants to liquefy the gas and ship it out. And the pipeline never got built. And now it is going to be built. And I know for a fact that it's very easy to convert an automobile. You just change the fuel tank to a propane tank and change the carburation, and you can run on natural gas, which is very clean, which solves all the problems of the greenhouse effect.
And Mount Angel, what's your question specifically about energy so we can get a response?
Well, why aren't people doing something for America? And why is it all the global this and the global that? Why aren't we worried about our country? Why are we buying from a communist country?
Got it. Thank you, Oregon, so we can get a response from Simon Johnson.
Well, I think this is a very good question. I think a lot of people have similar kinds of concerns. You know, what's in it for America, America versus the world economy, and so on. I think I want to make two responses to that. The first is, remember, it's America that built the system. After World War II, when the world was in ruins, it was the U.S. who took the leadership role. It was the U.S. who put real money on the table and built a trading system that pulled a lot of countries back out of the destruction of the war and led to growth spreading not everywhere, but to many parts of the world. So this was a good system. The U.S. is not in charge of the system, but the U.S. has a leadership role. The headquarters of the International Monetary Fund, for example, that's in charge of the payment system and overall macroeconomic stability, is a few blocks from the White House. So the U.S. has a lot of say over the global economy. Now, I think the second thing, though, is obviously things have changed a bit in the last 20 years. In particular, what's happened is the U.S. has run what's called a current account deficit. Okay, that's a little bit of jargon. It means that we've been spending, we've been buying more from the outside world than we've been selling to the outside world, and we've been financing that with loans. And if you remember 2 weeks ago when President Bush addressed the nation on the issue of the crisis, the first paragraph of his speech, you can go back and look at it, was about how foreign capital had come into the country and we hadn't really been able to manage that capital inflow. And that was a very good point. So particularly in the last 10 years, a lot of capital was coming in. We thought we could handle it. We thought our financial system was up to it. All right? We had a very good trading system, which the U.S. built. We had a very good financial system, we thought, which again the U.S. has built, and the U.S. has been instrumental in building this around the world, but we couldn't handle this amount of capital coming in, and it led to a credit boom, and it led to the sort of relaxation of lending standards and arguably to fraudulent practices. And I think as we go forward, we have to think about, you know, what do we want the system to look like? What's in it for the U.S. and what's in it for our partners? It's a very globally interconnected world. If you want to go back 20, 30, 40 years ago, you can't have the same income level. That will be a huge adjustment. That will be very, very difficult. I don't think that's where we're going to end up with this. I think, though, thinking about the system and explaining to people how it works for them is very important right now. And I think that message is not actually getting through.
There are two things. That caller mentioned energy. There are two small bright notes in all this bad news about financial markets. One is that the price of oil is now down near $85 a barrel, and the other is that that investors, I lost my second point, but the energy, $85 a barrel for oil, and what's going to be? The other is the dollar. The dollar has gone up in value. Are those good signs for us?
Well, it's generally speaking, yes, but it's a little complicated. So let me try and explain. The oil bounced back a bit this morning. Actually, went back over 90. But I think you're right. The overall trend is for it to come down, and this will address a lot of the energy concerns and a lot of what's been hurting people's pocketbook. If there's a big global recession and there's a big slowdown around the world, demand for energy goes down. Prices go down.
Right.
And actually one reason we never invest that much in alternative energies, every time we get worried about high energy prices, we get a big recession, energy prices slump down, and if it goes back down to $20 a barrel, we're going to say, well, we're not that worried about energy anymore. Right? So that is part of the cycle, and I think it will help people in a pocketbook sense, and that's the way it works. On the dollar, what is important, and you're absolutely right in this situation, is the dollar is strengthening. So when people are worried about what's going on around the world, they come into dollars. They particularly go into U.S. Treasury securities. They like to hold U.S. government debt. So that's a good thing. That tends to stabilize. It does tend to cause the dollar to appreciate or go up in value, and that makes it harder for the U.S. to export. And if you remember, the one bright spot of the last 6 months for the real economy has been exports. Exports and manufacturing have really picked up. So, you know, you win on one side, you lose on the other side. We're getting more stability. People are not running away from the dollar. That's very important, because that could be, you know, bad news. But when they come into the dollar, I mean, this is because Europe's in such disarray right now. They're coming into the dollar, trying to get out of the euro. That's causing us making it harder for us to export. So the next, you know, set of calls you'll have in 2 months will be people saying our export business just disappeared again.
Let's go to Topeka, Kansas. Good morning on our Independence line. Hi. Topeka, are you there? A little noisy. Long Island. Good morning. In New York, a Democratic caller. Good morning, New York.
Yes, sir. Good morning. I have a question I've been trying to get asked for like a year and a half. The question is this. In the 50s, when I was growing up, my father had a mortgage, and his mortgage rate was 3.7%. And the bankers still made plenty of money, and they had laws called usury that, made people keep lending within reason. Now we have more rates of interest here in the United States up to 30%, while Japan seems to be able to lend money at 0.5%. And for the average person like myself, I've seen this over and over. I just cannot understand what the problem is and why they can get away with this 30% interest rate thing. Thank you very much.
Well, I think that there's two things that have happened since the 1950s. One is we've had quite a lot of inflation. So 3.5% mortgages is fine, was fine back then, but if inflation goes up to 10, 15, even touch 20%, as it did in the 1970s, obviously no one's going to lend money at 3.5%. So interest rates went up a lot. We shifted to adjustable rate mortgages. And that part of the process, I think, actually worked pretty well. And we're still rather good at getting mortgages to people, and until the last couple of years, we were pretty good at getting people into mortgages that they could afford on a sustainable basis. So the financial innovation there worked quite well. However, I would agree with, I think, where you're going with this question, which is there's predatory practices have emerged in the lending business. I think that's pretty clear. We were willing to close our eyes to it for a while because there was a boom and house prices were going up and people could roll over their debts. Now I'm afraid what we're seeing, anecdotally, I think it's definitely there, is people getting turned down for car loans, even when they're good credits. We see lenders around the world saying they don't want to take on risky people. So there's going to be a contraction there, and I think a lot of stories are going to come out about how people were lured into loans inappropriately. Now, sometimes, of course, it was their fault. Sometimes people knew what they were getting into, weren't paying attention, or wanted to take the risk themselves. But sometimes I think they were also pushed into it, and it goes back to the point about deregulation, of course. The way that competitive forces manifest themselves and the way that salespeople were compensated in some firms, not in all, and of course most people working in most firms are very good, honourable people. But unfortunately, some of these aggressive sales practices emerge, and that pull people in to too much debt, and that's a problem for them, which has to be sorted out, and now it's a problem for the country. And because we're interconnected with everyone else in the world, it's a problem for almost everyone in the world is affected by this right now.
Simon Johnson is professor of entrepreneurship at MIT's Sloan School of Management. He's with us for another half hour or so, until about 8:30 Eastern, taking your calls on the global financial markets. There are so many countries, I don't know where to begin, but there are a number of stories in the Wall Street Journal this morning about different countries. In particular, one here about Russia. Russia investors want a bailout of the bailout, despite Moscow's $120 billion package. Stock indexes fall lower than ever, and oil's fall spurs worries. What's going on in Russia?
Well, two things are going on in Russia. One is the oil price fall, which we were just discussing. So Russia is an economy largely based on oil and gas exports. If you think those prices are going to come down, that affects how much money you can make in any business in Russia. It also affects the amount of money the government's going to have. So people are moving out of Russia for that reason. In addition, unfortunately,
moving, I mean investors moving out.
That's right. Yeah. Right. No, that's right. Yeah. Not citizens. Not at this point. So money moving out, investors moving out. The second thing is they built their financial system on a particularly precarious pack of cards or house of cards. Without going too much into the jargon and some of the little nuances or complexities here, they took a lot of risk, and they had a lot of the banking activity in the country was based on hedge funds, borrowing from hedge funds. Right? Now, the hedge funds have obviously taken a battering in this situation. They want to cut back on their risk exposure, so they're cutting back on credit to Russian banks. Now, the Russian banks had in turn lent to people who were speculating in the stock market, so they're calling back those loans. And you have a downward cycle there, and as the stock prices come down, people have to sell more because of the way the whole thing has been structured, and they're really in quite bad shape. I would emphasize the Russian government has a big war chest of its own, has a lot of reserves. It will almost certainly step in and use those reserves to stabilize the situation. Whether they'll come in, this week or next week, how much they'll want it to come down before they step in, that's an interesting question. It's tough to stabilize it when it's just in a straight fall
Still,
down.
how do you see this impacting, say, Russian investment? I know they've been major investors in London, in parts of the UK, major investors in places like New York City.
That's a good question. It's very hard to know. This is the problem with this kind of financial crisis. You get a lot of jumps, a lot of sparks. It's like a forest fire, where you can sort of see the main fire, and you can work on controlling that, but then suddenly it jumps to somewhere else. And exactly what will happen is because they have portfolios elsewhere, they'll sell some things, and that'll put pressure on other asset prices. Could be in London and New York, could be somewhere else where we don't even know that they have holdings. So these things have a way of spreading just like wildfires.
Good morning to Arlington, Virginia. Hi, Republican caller.
Yes, good morning, Bill. Good morning, Mr. Johnson. The problems we have, I think, is the most serious problem is that the public has lost confidence in Congress and their ability to fix anything. These career politicians we have, like Chris Dodd and Barney Frank and Chuck Schumer, they injected politics into economics. Now, if a bank or a lending institution has a problem, say fraud, embezzlement, misappropriation of funds, they bring in investigators, investigate, find out the perpetrator, remove the problem, and then they go on from there. This has not been done. The corruption that's in the system is still there. Article 1 of the Constitution gives Congress the authority to regulate and manage the economy. However, they've turned over this to the Federal Reserve, probably Paulson, Secretary of Treasury, gave him all kinds of authority here lately. Too much. He's more of a money czar than he is a secretary anymore. He can just practically do anything to the economy he wants. However, it's been corrupted to the point where we just don't have confidence in the system. Could you address that, please?
Sure. I think confidence is the key issue, and you're right that people have lost confidence. I think, though, they've lost confidence much more broadly. They don't understand, and mostly because it hasn't been well communicated, that the FDIC stands behind every penny of every insured deposit. It has never failed to pay out. It pays out the next business day. Typically, you don't even notice that the bank has been taken over. And the FDIC is backed by the full faith and credit of the U.S. Treasury. The FDIC will not fail. All right? And the FDIC actually, in almost every case, has also paid out the uninsured deposits. Okay? So people should think very clearly about that and have confidence in the banking system and the way the banking system is backed up by the insurance scheme. And I think the people who run the Federal Reserve system are extremely good, extremely professional people, and they will not let you down. And that's a very important message that I think somehow has got lost in translation over the past couple of weeks. Now, if I could just go to the point about Congress,
yes,
which I think is also a fair point. You know, you're absolutely right. The Congress delegates authority to regulate all kinds of things to various agencies, including the Federal Reserve, including, unfortunately, about 53 other regulatory bodies. And it's a mess. And there's no question at all this has to be consolidated. And anyone who tells you that's not on the table right now should be asked to go into the other room while we sort it out in this room. It really is very, very important. I would, though, want to put a positive word in for Congress. And my word would be this. If you compare what's happening in the United States over the past 2 weeks with what's happening in Europe, there's been a much more positive process of debate, constructive engagement, and yes, there were some bad moments, perhaps, but in the end, they came to they actually came on board with the executive branch, and they supported Treasury Paulson. Now, it turned out it wasn't a very good plan. I think that was somewhat obvious from the get-go. But anyway, the Congress's job was to respond to what Mr. Paulson and Mr. Bernanke proposed, and they did get on board with it. Now, there's going to be Plan B. There'll be perhaps a Plan C and a Plan D. I think that the democratic process in the United States worked rather well. In Europe, they're struggling in part because they don't have that same back and forth. The governments have not got to answer in the same way to an independent parliament as you do in the United States. And I think as a result, they're in a little bit worse shape right now. And looking down the road, one reason why the dollar is strengthening is people actually like the prospects for the U.S. to come out of this one stronger than Europe will come out of it.
That caller used the term for Secretary Paulson, money czar, which I hadn't heard before. Would it be beneficial because of Mr. Paulson's relationship, I think, with he comes from Goldman Sachs. So in the next administration, McCain or Obama administration, does that Treasury Secretary need to have that sort of background, to be that money point person for future crises that may come down the point?
The Secretary of the Treasury typically needs to have and does have the respect of the financial markets. And I think whoever becomes president would almost certainly choose someone who is very deeply steeped in those markets. However, I think it's also important that the new Secretary know a lot about crises. And it's very important that this person sort of worked in crisis situations, because what's happened, what ordinary business practice or ordinary business experience the last 35 years in the United States has been pretty stable. The last 2 weeks are totally off the charts. So you want somebody, and there are people out there, fortunately, there are people who've been through either very tough moments in parts of the U.S. economy or people who've worked in global crises. And there's a list of candidates on both sides, not a long list, but there is a bench that you can go to for Secretary of the Treasury. And that will be a very important appointment for the new president.
Let's hear from Portland, Oregon. Good morning, independent caller.
Good morning. You mentioned that the economic recovery bill went through the democratic process in a pretty decent way, unlike in other countries. However, what's floating around on the internet is Representative Brad Sherman stating that Congress was under the threat of martial law if they didn't pass this bill. I mean, it's floating out there. It was on C-SPAN. Further, Ron Paul even states that the Senate had no constitutional authority to make tax law. So this bill is, in fact, unconstitutional. And you mentioned that, Paulson's from Goldman Sachs. Well, there's indications that he still receives money from Goldman Sachs, which is a conflict of interest. And he is, in fact, or has been appointed absolute czar over U.S. economics. No judicial, no legislative review over his decisions. This was a draconian bill. The $700 billion was just sort of a benchmark. He has full discretion to use taxpayer funds at will, and there's strong indications that those funds will be used in the foreign markets. We're going to take on this toxic debt, and it's going to have a deflationary effect, and we could expect hyperinflation in the coming months.
Thanks, Portland. We'll get a response.
Yeah, I don't think that Secretary Paulson has unlimited powers. I think the initial proposal he sent to Congress was a little too much in that direction, and Congress pulled that back. I think that actually there's a lot of oversight. It's the Federal Reserve actually has a lot of discretion, a lot of powers in this situation, and that's good because you want them to be able to stabilize the markets and stabilize the situation. I really don't think you want to think about the personalities and the individuals having the wrong kind of incentives here. The problem is with the system. I'm afraid we built a system that got out of control. We built a financial system that we couldn't regulate, that engaged in dangerous practices. And we have to go back and look at how that system can be changed. And that's very important. It's not about the individuals at this point. It's about stabilizing the situation, rebuilding confidence, and then putting in place a couple of pretty straightforward, but politically tough, perhaps, pieces that'll get the recovery underway.
That caller brought up the financial markets legislation. Getting back to that, the front page of the Washington Post this morning has an article, feature article, Tipping Point, Unfolding Worldwide Turmoil Could Reverse Years of Prosperity. I just want to get your feedback to a little bit of this. Last week, the nation's political leaders said the financial system would collapse unless they passed a $700 billion rescue package for Wall Street. On Monday, the first day of trading after the plan passed, the financial system continued to melt down anyway. Here's why. The plan developed by Treasury Secretary Paulson to buy troubled U.S. mortgage assets might not start for another month, and despite its huge price tag, it already seems paltry compared with the scale of the rapidly evolving global crisis. And one quote here, people are realizing that the Paulson plan is not going to be nearly enough. It's not because the plan is ill-conceived. It looks like it's the right thing to do, but the problem is just growing astronomically. This is from Martin Evans, a professor at Georgetown of Finance and Economics.
Yes, I think that the plan, we all hoped it was going to have more positive effects. And I think the situation would have been worse if the House had turned it down on Friday. No question about that. The problem is that between Friday and Monday, there were a lot of events around the world. So we had a major German bank that needed to be rescued. The rescue broke down on Saturday. There was a shotgun rescue organized by the German government on Sunday. We've got Iceland, which is a tiny country. It's smaller than D.C., I think, in terms of population. Iceland has been run like a big hedge fund. And they've got terrible financial problems. No one wants to help them out. And now they say they perhaps are going to default on their debt. Now, this is small again, but it's further sort of cracks in the global financial system that are appearing. So to be fair to Mr. Paulson, between Friday and Monday, a lot of things happened. I don't know if you're familiar with the phrase living on internet time from the 1990s. It means we're all hyped up and working much faster and so on and so forth. I think we're living on financial market time. Financial market time is like internet time, but it has teeth. So unless you bring down companies, it'll destroy jobs, unless you move sufficiently fast. And policymakers have to really change gears in order to keep up with it. Even from last week, they're going to have to speed up. If they want sensible, good messages coming out of their meetings on Friday and Saturday, with all the finance ministers of the world are going to be here, they really got to get going right now. It's not business as usual, and they can't move at the usual pace because the financial markets are in the driving seat right now.
And as you said, the Wall Street Journal reporting today, Iceland risks bankruptcy. Leader says credit lines to Iceland's banks closed down on Monday and that's from the Prime Minister, Mr. Gerhard of Iceland. Let's go to Glenview, Illinois. Good morning, a Democratic caller. Hi.
Good morning. Hello, Mr. Johnson. I have a question and a comment. I was hoping, if you have time, to please address both of them. The question that I have is you had somebody on one of the news shows. There's a professor of business from University of Chicago who said that, it looks like, as you said, we might have to revisit this again. The confidence may not come back from the bailout. And his suggestion was to take all of the debt from banks that are in trouble, and financial institutions that are in trouble, and convert all of the debt, bank-to-bank debt, bank-to-government debt, and convert that debt into equity in its entirety, equity in those businesses, and completely eliminating the debt and making it an ownership issue. If you could address that as a possible thing. The comment that I have, and the reason I want you to address this is so that people just don't have my word to take for it. I'm responding to one of your callers who had to do with NAFTA, mentioned NAFTA and our sovereignty. One of the things that's very frustrating is, I was there, I watched what was going on at the time, and it's also true of GATT and some other things, that these were Republican-driven issues that Clinton signed into law after having to strong-arm Democrats. He got about 40%, if I'm not mistaken, of the Democrats to vote for it, whereas virtually every Republican voted for it, and it's with very few exceptions. And it's frustrating to hear Republicans talk about Clinton passing NAFTA or Clinton passing that deregulation bill. I can't remember the name, Glass-Frazier or something like that, when these are Republican-driven bills that he passed. And it's kind of like them saying, the pot calling the kettle black. Well, you gave us what we wanted, so it's your fault. Very frustrating.
Thank you, Illinois.
On the first part of your question about what you should do with the banks, there are various proposals out there, including that one, which is by Luigi Zingales of the University of Chicago. And I think now's the time when people are sort of getting their minds around what you should do. Clearly, there is a problem with banks not having enough capital. People fear that banks are insolvent. There's a lot of a question of problem debts. I wouldn't go exactly down Professor Zingales' route. I think they'd go another route, but I think I share with him exactly the point. I would emphasize, as he does, the point that you've got to look at bank capital, you've got to look at bank solvency, and you have to find ways to reassure the market short term the banks are not going to fail. And then I would add you have to really get to work on the underlying mortgage problem. You have to also probably provide a pretty substantial fiscal stimulus in order to soften the blow of the recession that's almost certainly coming. So I think bank capital, focusing on bank capital, debating that, and really getting the ideas out there is what quite a lot of economists and non-economists are trying to do right now. And I think it'll take a little bit of time to sort out the right scheme, but we'll get there sooner rather than later. On the second point you were making about NAFTA and trade and so on, I really don't think that the crisis that we're in right now, even the global dimension of the crisis, is about trade. It's about the financial system, and it's about the way in which the financial system spread around the world, and it spread to lots of countries that are not in NAFTA, and it's not particularly about free trade in goods and services. If one reaction to this crisis is to cut back on our global trade connections and reduce our trade with other people, I think that would be a mistake. I think we have to look at the financial system and the way the finance works. That has clearly led us into instability, and it's led to a very strange situation where the United States has problems that are usually seen in poorer countries, so-called emerging markets, middle-income countries, open to capital flows. So this is not good, and obviously we have to do everything we can to make sure we don't get through this and make sure we don't repeat it in the near future. But I would keep our trade relations off the table. We want to be able to export. We want to be able to grow out of this through selling to other countries, and other countries need to be able to sell to us.
Bella Vista, Arkansas. Good morning, and a Republican caller for Simon Johnson. Hi.
Good morning, Simon. Say, I believe everything that we have a problem with right now can be traced back to the politicians and their greed for a vote. Everything that we have a problem with on the monetary market, they wanted a vote, so they gave away a lot of things to get a vote. The young lady from Tennessee that spoke of the banks was correct. The young man that spoke about it from Virginia on the politicians was right. But until the politicians know how to say no, we're never going to get out of this problem. We have illegal immigration problem in this country. Why do we have that? Because the politicians want to vote. Has nothing to do with anything else. Everything can be traced back to the politicians and their greed for a vote. Thank you for your time. I'd like to know what you think about that.
Well, I certainly don't disagree that now is a moment to have some pretty serious democratic accountability and to talk about the business lobbies that were also engaged with the politicians, who paid what to whom and to do what exactly. I would also point out that there are countries around the world that are in pretty serious trouble where they don't have a democracy. So I don't think you actually need to have people competing for votes in order to get into this kind of trouble.
St. Augustine, Florida, on our Independence line. Hi.
Hello, good morning.
Good morning.
So many things, so many questions, so little time. I have a couple of different points to make and questions as well. In the sale of Wachovia, if Wells Fargo gets this deal, do they get to go back 20 years to take off over $7 billion in taxes? Also, $900 billion was just printed by the feds to infuse this illiquid market. Where exactly is that money going? What infrastructure projects is it going to build? And then you can just take two and go from there. Thank you.
Okay, let me take the second point first. So the Fed has provided liquidity to the markets. That's not long-term investment. That's generally very short-term money, but some of it may be overnight money. The core of the problem, the big symptom of the problem, not the origin of the problem, the big symptom of the problem is that banks are not lending to each other. And if banks don't lend to each other, the financial system doesn't work. So the Fed is stepping in to try and urge banks to lend, provide them with lots of liquidity, make them feel more secure. The banks are still hesitating because they don't know about the solvency of the other banks. And that's where things are glued up. And that's why we're looking pretty urgently at alternative ways to approach that, to rebuild confidence in the financial system. The Fed is doing a very good job, I think. Given its tools and given its standard ways of looking at things, I'm pushing them to think about it more as a big crisis that needs a big, decisive package to turn it around. But that's going to take a little bit of time for people to get their heads around that. And we probably need to see some more down days in the market before people really feel the urgency there. The other thing, the other point about Wachovia, I think we don't yet know the outcome because Citi and Wells Fargo are sort of fighting it out about who gets to take it over on what terms. So I think we have to come back to that one and see exactly how that's structured. I don't think it'll be anything untoward. I think the FDIC actually, after some potential, what you might see is some little bit of mishandling of some bank takeovers. I think it did a really good job with Wachovia. And right now, I'd be surprised if any taxpayer money or taxpayer liability is involved in any way in the deal that comes out of that.
In the wake of some of the financial news in the last couple of weeks, Securities and Exchange Commission limited short selling on the markets, and worldwide there's been a block on short selling in a number of countries. The Financial Times yesterday wrote an analysis piece saying that governments around the world have banned short selling following the backlash against, quote, rich speculators. However, according to this article, it may have unintended consequences. This is the process of this short selling in terms of betting on which way a stock price goes. What's likely to be the effect of these markets, these countries also keeping a tighter rein on short selling?
Well, I'd like to say that short selling is banning short selling is not even as smart as shooting the messenger. It's like shooting the messenger's bicycle, right? So the messenger still gets through, the prices still go down, but it happens a little more slowly. And we'll actually see whether the SEC did say they would lift the ban on short selling this week, in part because they banned what they can ban is the most direct way to bet against prices going down, but people are finding other more complicated ways to bet on prices falling, and so it's introducing various distortions. If they allow the ban on short selling to come back, I'm not quite sure what's going to happen. I mean, it's in this very difficult situation. Wouldn't surprise me if they postpone lifting the ban, if you like. The basic point is this doesn't help. This is trying to relieve, you have a terrible fever and you take an aspirin. You might feel a little bit better for a little while, but probably you should go see the doctor and get the problem fixed.
Let's go to Virginia. Bland, Virginia is on our next caller on our Democrats line. Hi. Virginia, good morning. Virginia, you there?
Good morning.
Hi.
Yes. Yes, sir.
You're on the air, sir, so if you turn down your radio or television, you won't feed back on us.
Oh.
Just hit your mute button there.
Satellite takes a little while to get here, but sorry.
Bland, I'm gonna put you on hold for a second and go to Edwardsburg, Michigan, on our Republican line. Hi.
Yes, Mr. Johnson. It's very interested in your input this morning. Let me tell you what has me very concerned. we've been hearing about the volume of derivatives for a couple of years, figures like 90 trillion, most recently 65 trillion. Those, I think, represent loans. And as those unwind, which they have to unwind, I think, they're either going to be paid off or they're going to be represent losses to somebody. The Federal Reserve is already, I think, irrelevant. They've run through all their assets, and now they're relying directly on the U.S. Treasury for funding. The FDIC has run through all of their assets and going to rely on the U.S. Treasury for funding. And to me, these losses, if you got 65 trillion of derivatives, and we take a significant chunk of losses there, could be in the range of 10, 15 trillion, maybe 20 trillion. Where in the world are these funds going to come from? The U.S. Treasury right now has, our national debt is up to 11.3 trillion. It sounds to me like these are requirements way beyond the resources of all of our financial institutions.
Okay, Michigan, first, before you answer, what's he talking about when he talks about derivatives?
Okay, so derivatives, there's a bunch of different kinds of contracts that you could write. Insurance contracts, for example, are often written in the form of derivatives, the so-called various kinds of options. And the key thing is this headline number, which the various estimates out there, but the caller's estimates were certainly in the plausible range. That is not the amount of money that would be lost on those contracts. There could be losses, and in the case of AIG, the big insurance company, there were losses, but they're in the hundreds of billions of dollars, not in the trillions of dollars for that company. We know that. Now, the bigger point, though, is an important one, which is how much can the U.S. government afford in this situation? And, of course, the caller is right that what it really comes down to is the ability of the U.S. Treasury, the U.S. government, to borrow and to be able to pay back that debt, to service that debt. And the debt we have in the United States is somewhat on the high side. It's certainly not at dangerous levels. And the mistake you want to avoid is the mistake of Japan in the 1990s, where they tried to respond to somewhat related problems, certainly a big fall in asset prices. Real estate was their problem. That came down a lot. They tried to respond by doing a little bit of fiscal stimulus here, a little bit of fiscal stimulus there, and very soon they had a very big debt problem, and very soon being within 10 years, and they hadn't got growth back on track. What you really need to do is address the issue of bank capital. And the exact amount that you would need to bring bank capital to a satisfactory level is still being debated, but it's nowhere near the numbers that the caller was talking about. If you address bank capital, make sure the banks are solvent, and you do that through the Treasury putting in capital and getting preferred equity. That's the kind of deal Warren Buffett gets when he comes in and rescues a company. I want the deal Warren Buffett gets. He gets good deals. He's a very smart investor. U.S. taxpayer gets Warren Buffett type deals. Everybody feels pretty good because the U.S. Treasury is now in as a stockholder in these banks. The banks, many of these banks are very well run. Many of these banks, most of these banks actually, don't have a solvency problem. They've just got caught because no credit is available for anyone on any terms right now in some situations. Well, so you turn around the bank capital, and then you can use a fiscal stimulus to support the economy, but only when you've got the banks fixed. And you also, of course, need to address the underlying mortgage problem, at least get a deceleration of the decline in house prices. So this is a package which, let's be honest, is going to cost some money, and it's going to cost some trillions of dollars. Mr. Paulson asked for 5% of GDP, and he wants to spend it in a certain way. I think that's not going to do it. But usually this kind of party, this kind of big credit boom we've had, usually you can turn around for something like 10 to 15% of GDP. Now, that's a lot of money, and people are going to be angry about having to add that to the national debt, no question about it. But it's not, it is affordable. The U.S. can afford it. Particularly if we address it now and address it properly. If we wait, if we drag it on for 5-10 years, that will be more difficult.
One more call here. Bland, Virginia, you're back on now. Go ahead.
First, I'd like to thank you, Simon, for having your visitors and giving the American public a chance to speak, at least. Needs to be more of this, but there's about 3 points I'd like to make. On this government borrowing of $700 billion, why don't they borrow it from the oil companies who have billions and billions in reserve that they have taken from the American public, and then set a flat tax and close the loopholes so that the American people actually get some? And they always keep talking about mainstream or Main Street, but they forget about the poor.
Thank you, Virginia. Last comments?
Well, obviously, we need to borrow from someone, and the scale of this borrowing is more than an individual company or a set of companies can provide. Just to give you some perspective, Mr. Buffett has, according to his website, around $45 billion in cash and near cash. That's a lot of money, but we need more, right? So that's why you have a government. The government is the only entity, the only organization that can deal with a problem of this scale. You might say the government got us into it, that we can debate that for a long time. I say let's get the government needs to get us out of it, and then we'll go back and sort out who did what to whom and when and so on. I would like to emphasize one last point about financial and economic literacy. I think what's happened in this country in the last 2 years on this front is fantastic. I think the number of people who really said to themselves, my goodness, how did this happen? Why wasn't I told? How do I find out more? That is really very good as far as I'm concerned. And if I could just mention at the end, my website, baselinescenario.com, we have a section on there called Financial Crises for Beginners. We're writing it in a style that you should understand. If you don't understand what we put on that website, you can put a comment up there saying, please explain this term or that term. This is jargon, I don't get it. I think we all owe it to ourselves to explain this clearly and to argue it out in plain English. I say let's first argue about what we do next, how we get out of this. Then we can go back for sure and argue about how we got into it and make sure we don't get into it again.
Our guest has been Simon Johnson, MIT professor and senior fellow at the Peterson Institute for International Economics. Thanks for being with us this morning.
My pleasure.
In just a moment, we're going to hear from two college students who are also leaders of their respective parties at Belmont University in Nashville, site of tonight's presidential debate. First, though, to the hotline and Amy Walter, an update